Today, we decided to talk about hybrid funds. As the name suggests, hybrid funds are a combination of equity and debt. But it's not so simple. You have several kinds of hybrid funds as well. There's something called as hybrid equity funds and hybrid debt funds. Now the question is, we often tell you invest in equities for the long term and invest in debt funds when you have a medium term or a shorter term time horizon. What do you do when you have a hybrid fund in your hand? And secondly, what sort of an addition do they make in your overall portfolio, which may already be having a combination of equity mutual funds and debt mutual funds? So let's discuss that and more with Harshavardhan Roongta. He's joining us right now live on The Money Show, and also to answer all your questions and queries. Harsh, it's always a pleasure having you with us on TMS. And today's topic of hybrid funds is something that we thought we'll pick up. The last 1 year have not been that bad for hybrid funds as it has been perhaps for a small cap or a mid cap fund due to a variety of reasons, and perhaps because of the constitution of some of these hybrid funds. I mean, on one side you had some of these global funds and gilts funds especially do very well. So, it took in the positives from that, but it also had to absorb some of the negatives from the small cap and equity parts of the portfolio as well. So first up, hybrid funds as an instrument. I mean, how do you like them? What are the advantages and disadvantages you see in them?
Well, if you're talking about hybrid funds, let's just understand what are hybrid funds. So as you rightly said, there are a combination of different assets put together. So you will have equities in it, you will have debt, you will have equity derivatives, you could even have precious metals such as gold in it. So hybrid means a mixture of two different or three different asset classes put together. Now within the hybrid fund category also there are different types as categorized by SEBI. So the first one, if I may talk about, I mean broadly let's talk about two or three of them. So the first one would be a conservative hybrid fund. So a conservative hybrid fund has a lesser portion of equities and a larger portion of debt. So you will see the equity portion may be restricted to about say 25% of the investments totally being made of the entire portfolio. So the portfolio consists of say about 1,000 crores, about 25%, about 250 crores will be equities and the rest will be debt. Now the other type of a hybrid fund is a balanced hybrid fund. Now in this, typically the ratio of equity and debt would be about 50-50% each. So you'll have half of the portfolio being in equities, half into debt. Now there is another category which is most popular because of the preferred taxation rate that it enjoys, which is an aggressive hybrid fund. So the mandate as per the Income Tax Act is that a minimum investment of 65% needs to be made into equities and the rest into debt. Then it qualifies as an equity fund from taxation perspective. So an aggressive hybrid fund will have a minimum of 65% into equities and the rest in debt. So these are different kinds of combinations available in which an investor can pick and choose to invest based on their own risk profile. So somebody says I don't want to take too much risk, I want to have equities in my portfolio, but I want to restrict them to say probably 15 or 20%. So then a conservative hybrid fund is available. If a person wants to take more risk and take a smaller portion of debt in it, so an aggressive hybrid fund is an option that an investor can choose to include into their portfolios. Now there are certain advantages of a hybrid fund. So one being of course that you have a combination of both put together. So you don't have to really buy two different schemes on your own. Suppose you wanted to invest 10,000 rupees and you wanted a combination of 70 and 30, 70% going into equities, 30 into debt. So what you would ideally do, 7,000 rupees you will invest into an equity fund. You'll search what kind of equity fund you want and you will invest 7,000 there. 3,000 you will invest on your own into a debt fund. Instead, what you could do is just put the entire 10,000 rupees into an aggressive hybrid fund, which anyways has about 70% in equity and 30 in debt. So that headache of choosing two different schemes, managing two different schemes is taken away from your side. The other advantage of an hybrid fund is the automatic rebalancing. So what happens is because there is a ratio assigned, which is that if I am investing 70% in equity and 30 in debt, which is the assigned allocation in an aggressive hybrid fund. Now, in case the equity markets start doing very well and the allocation, the equity portion, the valuation goes to about say 75 or 80%, and debt of course hasn't gone up that much, so the fund manager will automatically do a rebalancing. They will sell some bit of equity and buy into debt to maintain and bring down the ratio again to 70 and 30. So this kind of rebalancing of the portfolio was done automatically. An investor need not take the headache of doing it himself. So these are broadly the 2-3 different kind of advantages. These are the different kind of products in different categories available: conservative, balanced, or an aggressive, which an investor can definitely consider based on their own risk profiles.
Harsh, when we talk about equity and debt, it's plain and simple. That okay, you invest in equity mutual funds for the long haul, for wealth creation, minimum time horizon of 4, 5, 6 years, and then you have debt funds where you can, park your funds for the medium term, maybe 3 years, and liquid funds are of course hardly a month or 2 months or 3 months. How does hybrid funds fit into an investor's portfolio? Which investors should consider a hybrid fund?
So, well, if you're parking your money into debt with a view to redeem it probably in a month's time, 2 months, or even 1 or 2 years for that instance, then hybrid funds are not something that you can consider. Hybrid funds are your long-term asset allocation kind of product. So, if you're looking at an aggressive hybrid fund which has a minimum of 65% in equity, and in case you're looking to liquidate, you cannot only go out and say that I've liquidated only the debt portion of it and let the equity be itself. So, you redeem, so you have the risk involved that is there with the equity investing. So minimum time horizon of 5 years and above because you have 65% and above in equities. If you have a shorter term requirement, but not as a liquidity needs. So liquidity, by mean of liquidity, I mean as in you're parking your money temporarily and you're looking to redeem as and when required, then even a conservative hybrid fund is not for you. Conservative hybrid fund has up to 25% in equity. But again, you have to have a 3 to 4 months or 3 to 4 years time horizon in your mind so that the equity portion has time to go through its entire cycles. You don't want an equity market to be doing well, unfavorably and your valuations being low and then you need the money and you withdraw. Those 75% into debt, the effect of 25% can be significant on your portfolio.